Good morning. How is everyone today? This is Paula White, your instructor for Accounting 233, and this is the week 2 lecture. We have two other students on right now, and I'm going to ask that when they want to ask a question, just unmute your microphone and just speak out, and that way, with only 3 of us on the line, it'll work out probably better than me trying to check your chat, and then I missed the chat because you've already answered it yourself. So if you have a question, and when you have questions, just stop and unmute your microphone and talk to me. If you don't have a microphone, then I'll check chats ever so often anyway. Does that sound good for everyone? Okay, so we have representatives, looks like, from the Midwest, Wisconsin, from the East, Georgia, and I'm from the California area, really from Illinois, but now in San Diego. And the heat is killing us because we don't have air conditioning here. And we're tired of going to bed when it's 90 degrees in the house. But that's what you get from living in a desert, right? Okay, so we are recording. So this is week 2. Everyone seemed to have done well in week 1. Again, this is our agenda. How to prepare for the lecture. Taxes are not an extension of GAAP. It's their own little animal. We talked about that last week, and we'll briefly mention it this week. How to be successful in this course. An overview of the problems that are similar to your homework. I kind of pulled a little trick on all of you last week, and they were exactly your homework, including the amounts. This week they're a little bit different, but they're essentially the same type of problems. We're going to cover the 1040 some more, irs.gov. So to prepare for the lecture, it's better to try to read the text before you pop in to listen to the lecture. The reason is, no matter what, you need to get some knowledge base built. Even if it doesn't make sense, you need to kind of know how the chapter and how the material is actually organized. Like last week, we talked about the tax forms. We talked about filing status and income and the basic calculation of AGI, taxable income, and tax. That's what all last week was all about. This week, we're going to be doing something differently. I believe you have the publisher's PowerPoints already available to you in your course material. So I'm not doing the PowerPoints. I'm doing something differently to try to pull that material together. So, does taxes differ from accounting? They're very similar, and in fact, if you do corporate taxation, which is not this course, to do a corporation's tax return, you put in the taxable income statement, tax-based, and then you put in the balance sheet from the books, and then there's the M1, M2, and M3 sections of the corporate tax return, in which you have to reconcile book to tax and tax to book. So they're similar, but they're different. There's over 40,000 pages of federal tax code, and that's law. These are codified law passed by Congress, and they do include social engineering. Why do you think there's in your itemized deductions the benefit for people owning homes? You can deduct your mortgage interest, your mortgage taxes. Why do you think that is? to encourage people to purchase homes. Why do you think people are encouraged to purchase homes? It is to get that industry up and running and continuing to prosper. Because if construction prospers, then the trades prosper. If construction prospers, then the manufacturers of the materials prosper. If the manufacturers of the materials prosper, then the workers prosper. Workers in the manufacturing facilities prosper. If everyone prospers, then people spend money. If people spend money, guess what? Everyone prospers again. So it's a way of social engineering. It does include politics. There's a box on page 1. Let's see, where is it? This is a very simple way, but do you want to have $3 of your taxes go to the presidential election campaign? There's I would think getting Obamacare and health insurance in. We have a health savings account. Government wants us to save instead of being spenders. So there's a saving tax credit for savers, and there's politics in the development of the tax code. There's not politics or social engineering in accounting. And laws are written by Congress to generate revenue for our government. So my recommendation to be successful is to read the book first, read the homework problem, determine the rules that apply, and then apply the rules. So how can you be successful in the course? Simple. Don't throw away any points. If I would have a nickel for everyone who didn't do their daily checkpoints, I would be a very, very rich person. So do the daily checkpoints each and every day. They are available only for 24 hours. Participate in the discussion forums. Most of the people in this particular class is, and that's good. There's a few people who aren't. But remember, your initial posts are due Wednesday. That's tomorrow by midnight Mountain Time. And then it needs to have research in it and an APA reference citings in it also. Two response posts are due by Saturday midnight Mountain Time. And late posts after the week ends are not graded for partial credit. If you and I have a conversation and then the conversation ends and 2 weeks later you go to the same room, an empty room, and say something, is that a discussion? No, it's not. So this and all accounting courses, of course, are easier if you keep up week by week. This is not a course that you can successfully complete at the last moment. You cannot wait till week 4 and try to get to the tutor on Thursday and Friday so you can do everything by Saturday. It doesn't work that way. Take advantage of the tutors and the lectures, and the assessments cannot be reset. I don't believe, okay, in this course, the assessments, yeah, your quizzes cannot be reset. But your final exam is, you do a tax return. So you basically have to drop down those files and work the tax return form. So what is this week's homework all about? It's about inclusion and it's about exclusion. So we have 3 problems that we need to solve. And there's 3 problems, and then there's an essay. The problems are 353, 434, and 435. And the article that you need to find has to be about including or excluding certain type of income. And you're to write a 1-page report on how inclusion or exclusion of that would affect your life or your career. Remember, this is income tax. So it could be anything on the tax return that could impact you. So that could be a very interesting one to do because it becomes personal that way. And last month when I taught this course, someone said, I don't have a job, I don't file a tax return, so how can it impact me? I said, well, that's very simple. Look into the future and see what you think your future will be about. So you will be having a good job. Do you want to purchase a home? Do you want to give to charity? Do you want to do this, this, and that? So if it's not in your life at the moment, project into your future to see what your life would be, and then do it on that basis. So here's the 1040 tax return. We went over it last week, but I wanted to show you, this is for your final exam. You're going to have this exact same form. You need to fill it out, and the form you'll be downloading will be appropriate, and you're going to hold on. I'm going to pause just for a moment. You good? Are you good, Cecilia? Okay. We just have a repairman coming in. So the form that you'll be using for your final will be this exact same form, and you could type inside of each one of these purple areas. It's a fill-in form. So if we were to do last week's homework in that format, you were given one of your homework questions was, you had an 18-year-old who had interest income, had a W-2, and one scenario was he's independent, and the other scenario was he's a dependent of his parents. What was his taxable income? So for him, you would put the name. Let me see if I have a pen. Annotate. Spotlight. Okay, let's see if this works. You would put his name, first name, last name. He doesn't have a joint return. You would put his home address. If he has an apartment number, city, town, and zip code. And we're not dealing with foreign right now. If he wants his $3 to be, 3 of his tax dollars to go to the presidential campaign, he can do that or not check it at all. What did we decide his filing status to be? For that particular 18-year-old, he was single. You have married filing joint, married filing separate, head of household, and qualifying widower with dependent child. This was your last question on your last week's homework. It was all about the section. It was about what form, the filing status, how many exemptions they could take, and I believe child tax credit was part of that homework problem from last week. So continue on. If you're single, you can take, and if he's independent, he can take himself as an exemption. And if he can take himself as an exemption, it would be 1. If he's not independent, then he cannot take himself as an exemption, and this would remain 0, blank. So if he was a dependent of his parents, then the parents get the exemption. If he's his own tax return and he's independent, he gets to take himself as a dependent, as an exemption. And Dependents have to have first name, last name, social security number, and the relationship to you. And you need to check whether or not the child's under 17, qualifying for child tax credit. Let me undo the annotate.
This is the way.
Yes, what?
Yeah, for this final one, is there actually doing this on ourselves, or is there a template or something that we're going off of with some information?
Oh, for the final exam?
Yes.
Oh, you will have some you'll have some data given to you, like
Okay.
you're married, you have income, you have this, and the other. You will have all that information. You just need to fill out the form.
Oh, okay. I wasn't sure if it was just for us to do, hypothetically, or.
No, you're given the data.
Okay.
You just have to fill in the data.
Okay.
And I'm making sure that you succeed better than my last course, because the last group did not even fill in the filing status at all. They went down to, where is it? They calculated AGI, and they went to, where is it? Taxable income.
43.
Thank you. They went to taxable income, and they didn't calculate tax, but their taxable income, they dropped down and gave it back to the taxpayer as a refund. A lot of them did that. So I'm making sure that you are familiar with last week's homework as they affect the form, this week's homework next week as it affects the form, so you won't be, if you've never filled out one of these forms before, I just want to make sure that you're in good shape. Have you done your own taxes?
No, my wife does.
Your wife does. Well, now you can know what she's doing then, right?
Well, I filled those out before from jobs.
Yeah.
They're a pain.
Okay, so I'm going to undo this. Okay, how do I undo? There. So that's how we went on last week's. The 18-year-old had wages. I believe he had dividends, which would come down to total income, therefore total adjusted gross income, which is where we stop for his particular problem. Okay, other resources. I have used Quick Finder. I just said there's 40,000 pages of federal tax law. There's also many, many pages for each state for their own state tax law. So how do you really keep everything straight? You can't memorize everything because that's too much to memorize. You have ability to go into online resources to go into the law itself. And we also have cheaters like Quick Finder. Each one of these books are around $50, but they are a good source because at your fingertips you have everything you'll probably need to know about individual taxes or business taxes or nonprofits, and professionals use these. So they have a tab, like for individuals, it's an inch thick. And there's a tab for each section of the tax return. And you go to that section and look it up, and it's something you can use and gain your own confidence. But it's also something you can use in front of a client in a professional setting, because if they're questioning something, they can say, well, that's simple. And you talk to them and you see that they're glazing over, they can say, let me show you something, and just get your book out, turn to it, and point to the paragraph and say, this paragraph applies to you, this one doesn't. So this says, no, you cannot take this deduction. And then they buy it because you just told them. They just saw it in a way that they can understand. And if they had to look at it, you can show them the tax code itself, which you never quite have to get to that point. Career path. Enrolled agent. I believe you need to be a bachelor's degree, but you don't have to have a CPA. This is from the irs.gov website. And to become an enrolled agent, this is an agent enrolled with the IRS to be the liaison between the taxpayer and the IRS. You can prepare tax returns. You can represent clients that you've worked with. You can represent clients with the IRS and be advocates for their, hold on a second, I need to shut the door. I apologize. We're getting different internet in, and the guy came and he wants to hammer the walls. So to be the enrolled agent, you can do the tax returns, you can represent your client and try to get offers and compromises. It's a great career path if you decide to love taxes, working with clients, and if you like this class, it'll be a good way to go into this. Okay, so the homework for this week. You have chapter 3-53, and this is a problem about court awards and insurance settlements. So what amount, if any, must be included in gross income for each of the following taxpayers? Well, we have Bobby, and she received $2,500 from her insurance company when her automobile, which cost $3,700, was stolen. So what do you think? Is that included or excluded from gross income? Terry said included. So Terry, why do you think it's included? Okay, so we have one vote for included and one vote for excluded. Okay. So it is excluded because it's a recovery of capital. The car costs $3,700. She was able to recoup $2,500 of her cost, or her cost basis of $3,700. So it's a recovery of capital. Does that make sense?
Yes.
Okay. Now we have Mary. Excuse me. We have Mary, and she received $4,000 from her brother. She had initiated a lawsuit against him in an effort to recover $4,000 that she previously loaned to him. The brother paid her back before the case was tried, and she dropped the lawsuit. So would this be included as income or not included as income? Okay, so, and again, we have a tie. We have an included because it was a loan, and we have excluded. The reason here is I believe it's excluded. You got me confused now. It's excluded because it was a repayment of a loan. She actually provided her brother $4,000. She expected that $4,000 to be paid. That $4,000 that she gave as a loan was not a tax deduction for Mary. She just loaned her brother $4,000. And he paid that loan back. So it's just like I loan you $200 and you pay me back my $200. It's not taxable income. And the fact that she received this, the lawsuit was irrelevant here. She had initiated a lawsuit. Well, that probably encouraged him to take her seriously and pay back. So she dropped the lawsuit and she received her money. The real part of this problem was she loaned previously, and this is him paying her back. Now, if she charged him interest, would the interest be includable or excludable? If she charged him interest and he paid the interest, yes, interest would be included as taxable income because that is your receiving payment for passage of time when you didn't have use of your money, because your brother had use of your money, you did not. So yes, interest would be included, but the actual payment back of principal of the loan would not be included. Good job. So now an accountant, you sued a client in order to collect your fee for doing taxes. Would the accounting method make any difference if it was includable or excludable? Included or excluded? So what do y'all think? Do you need more information? No one's talking to me now. Okay, so let's say you are an accountant, a self-employed accountant. You did tax work for your client and you haven't been paid yet and you're on a cash basis. It is income for a service. Yes, Terry, that's true. And Dennis says it's included if the accountant won the case. Okay. These are all good points and at different positions, 100% accurate. Let's say that you are a cash basis taxpayer, which means when you receive revenue, actual cash for your services, that's when you pay them. So in this situation, if you're a cash basis accountant and you sued a client in order to pay tax work, would the accounting method make any difference? So if you were a cash basis taxpayer and you're suing your client for tax work, then you haven't had that taxable income yet, because taxable income would be cash basis. You would have to receive the cash from your customer for it to be a taxable event. So if you were a cash basis taxpayer as this accountant, you haven't received money for doing this tax work, so that revenue has not been recorded on your books and is not recorded as taxable income on your tax return. However, if you are an accrual-based taxpayer, which means I send her a bill, and when I send her a bill, let's go back to accounting, you issue an invoice, you debit accounts receivable, and you credit tax fees income. So if you're an accrual-based taxpayer, you have billed for your income. It becomes taxable to you as an accrual-based taxpayer, and you've already paid taxes on it. So if you sue a client, then now for taxes, you can apply and have this become a bad debt. It's one of the steps to documenting a bad debt expense for accrual-based taxpayers. So it's a simple 2-line question which has so many different variations to it that you can really have a good conversation. So you're accrual-based taxpayer, it's in your taxable income, you pay tax on it, and you sue your client for the fee, and Dennis says if the accountant won the case, it's taxable. So you already paid it as an accrual-based taxpayer. If you paid the income and the tax is yours to pay, you sue the client, now you can have a bad debt expense. Now the client pays you. Then you have to, since you debited the bad debt expense, now you need to, if the client pays you after this court hearing, then you have taxable income because you had a tax deduction for the bad debt expense. That bad debt expense got paid, so now you have to undo that, reverse that bad debt expense, which is an income to you. Interesting question. So now we have Dean, number D. Dean has incurred $5,000 of medical expenses so far this year. He paid $400 of the expenses himself out of pocket. His insurance company paid for $3,000 of the expenses. The hospital is suing Dean and the insurance company for the balance of $1,600. So what do y'all think? So again, the question is, what amount, if any, must be included in gross income? So someone says, I don't understand the question. And a lot of times you have to look into these questions. Let me move this down. And it's not income. So Dean has incurred $5,000 of medical costs so far. You paid $400 yourself. Your insurance company paid $3,000 of the expenses. That payment of $3,000 is not income to you. That's because you have medical health insurance. So the $3,000 is not income to you, and the hospital is suing you and the insurance company for the balance of $1,600. So if anything, the $3,000 would not be income because that's the only time that someone paid on your behalf. The $400, he paid $400 of the expenses himself. That would be a part of Schedule A, the medical deductions. That's your out-of-pocket cost, and If it's above 7.5% of AGI, then it can go toward your itemized deduction. So this 400 would be including helping you with an deduction, not for taxable income. And the hospital is suing you and the company for $1,600. If the insurance company pays at $1,600, then it still would not be income, because that's what health insurances should do. They should pay for your health insurance issues. So no, it's not income. So that life doesn't come to you as a very neat package when you do tax returns for clients. So sometimes you just have to read through and make sure you get your head straight. Let me try and get your head straight, because the question is, what amount, if any, must be included in gross income? So we had to divide these 3 lines up to figure out what would be a benefit to you, not a payout to you in gross income. Okay, so excludable gifts. Which of the following would be includable or included in gross income? We have Alice, and she appeared on a TV quiz show, and she received a prize of $2,000. Do you think that's included as income, gross income, or not? Okay, I think we have 2 included, and you're correct. It's included as a taxable prize. Okay, Ben received $650 from his employer because he developed an idea that reduced the employer's production costs. Would that be taxable income? Oh, I have 1 possibly and 1 yes, included, but it can be seen as a gift. Good question. So you're Ben and you're working at your employers and you came up with an idea. A lot of times businesses have a employee suggestion box. I think a company like, what is it, Google, or one of the high-tech companies, I believe 1 Friday each month, the employees can work on anything that they want to work on. Anything. And that 1 Friday a month can get, if they come up with the best thing, they can get a substantial bonus. And it kind of encourages initiative and creativity on the job. That bonus would be included in their W-2. I remember at Southwestern Bell, we worked on this huge project. We were taken out to lunch by the company as congratulations. We were taken out to lunch and then presented with a Lady Liberty silver dollar. Well, the lunch was a tax deduction for the company, so that wasn't taxable income to me. But the silver dollar, even though they handed us the silver dollar, uncirculated silver dollar, we received a letter that same day saying that our gross income would be increased by $50 on our next W-2, so that taxes can be taken out. So they gave me a $1 coin that yes, it was a silver dollar, so it was worth $50. But they gave me a dollar coin, and I had to pay taxes on it as if it was $50. So that gift, even though it was currency, a dollar, was worth $50, and I needed to pay taxes on it. So anything that the company really gives you over $25 is taxable, and it will go into your your information in your W-2 as gross income. So that's how it translates back to your tax return, because the first line of data in your tax return is gross income from wages. And Terry wants to sign him up for the job that has every Friday off that you can work on anything. Yes, and most companies do that bonus thing. They even do it with cars. So there's no such thing as a free lunch or free money, but not the Army, laugh out loud. Hold on just a second. So let's go to number 3. Yeah, Terry must have been in the Army. Yeah. Oh, wow. So thank you for your service. If you were people in the Army, my father was a merchant marine in World War II, so I really respect the military. Okay, so number 3, George. He borrowed $400. Oh, thank you, Terry. Retired. Wow. I'm glad you're talking to me. This is more fun than just talking to myself. So we have one 25-year veteran, and Terry hasn't disclosed how many years if he's even in or out right now. But thank you. Sorry. Thank you for your service, and America is better off because of your service. Thank you. So we have George, and George borrowed $400 from his mom in order to finance his last year in college. When he graduated, George's mom told him, "Oh, don't pay me back, son." So she intended the $400 to be a graduation present. Is this included in income or not? Yes, Terry, it's excluded from income. It's a non-taxable gift. Very good. So I think we have one more, and it's life insurance. And Tim is the beneficiary of a $60,000 insurance policy on the life of his mother, Chris. To date, Chris had paid premiums of $16,000. What gross income, again, is gross income, must be reported in each of the following cases? I'm getting oh, hold on. I'm trying to get my chat box up so I can see this as you talk to me. So Chris elects to cancel the policy and receive the $20,000, which is a cash surrender value of the policy. So what would be, is there gross income here, and how much would it be? Remember, your mom paid $16,000 in, and the cash surrender value was 20, and she canceled her policy and received her 20,000. Okay. We have 2 included and one says 20,000 is taxable. And it's 4,000 is taxable in income. And the reason is, even though the 60,000 is the face value, your mom paid $16,000 in, and she only got $20,000 in return. So she got her $16,000 back, but the 4,000 is growth, which would be interest or dividends. So it would be $4,000 taxable. Now, scenario number 2, Chris died, and Tim receives the face value of the policy, $60,000. $60,000. So is there any taxable income? So we have included here. Well, nothing is taxable for insurance policies that pay out because the event happened. This is a life insurance policy that is designed to pay when someone dies. And Chris died, and they had to pay the face value of the policy, which is $60,000. So life insurance policies are not included in taxes when the person dies. It's excluded. Now the last one on this one is Chris dies and you elect to receive $17,500 per year for 4 years. And this one does take a calculation. So why don't I just go ahead and help you through that one, because it's a little more complicated. It is $2,500 is taxable each year for 4 years. You take your amount that you received, you elect to receive per year, which is $17,500, and the $60,000 divided by 4 is $15,000. So if you elect to take $17,500 times, let's see, I'm going to get my calculator out. 17,500 times 4 is $70,000. So you're going to take, to get the $2,500 taxable in each year, the $17,500 that you chose to receive, and subtract that from 1/4 of the face value, or 60,000 divided by 4. You're going to get the difference between 17,500 and 15,000, which is 2,500 included. If that calculation doesn't make sense to you, then 17,500, the amount that you're receiving, times 4 years is 70,000. The face value is 60,000, so 10,000 is taxable. This is over 4 years, so it would be $2,500 a year. Okay. So we covered the material. We re-emphasized how to be successful in class. We went over your homework problems, which are very similar to your actual homework problems. This time the names and amounts are different, but it's basically the same homework problems. And are there any questions about how to be successful for this next week? We have a very interesting discussion going on about what should be included in taxable income, and even on the legal versus illegal activity perspective. So Terry says no questions at this time. And Dennis says no questions. So with that, I will say have a great week. And I look forward to reading from your voices, from your discussion forums. And I'll talk to you and listen to you next week. Have a great week, everyone. You're welcome.